Alright, we should be live.
Live here? Okay.
You live there?
Check with the next one.
Alright, welcome to Chat Room Podcast. I'm Myke Reed, co-host Albert Jones, and we have a special guest here, Floyd Simpson. You want to tell people about yourself?
Yeah, I definitely will. So, my name's Floyd Simpson. I've been in the financial services industry for close to 16 years now. Spent the first 2.5 doing operations, then spent about 2.5 doing management consulting for wealth management clients. So that's about 100 plus million of investable assets. After that, did 5 years of institutional asset management, worked with a lot of public pension funds, corporate funds, foundations and endowments, balance sheet and operating assets. And for the past almost 6 years, I've been doing manager research, and now currently I am the team lead for manager research. I lead a group of close to about 3 to 4 individuals, depending on how I slice up a half and half. Along with that, I'm also an associate global PM. So that's what I'm doing on a daily basis. In the past, I've been a registered rep, used to hold a 7 and 63, no longer hold it because I don't need it. Currently have a CFA and a CFP designation. And, outside of that, co-authored two investment white papers, and I'm the secretary for NASP Philadelphia, which is the National Association of Securities Professionals, along with being a member of the investment committee for the Truman State University Foundation.
Okay. What was those two white papers on?
So those two white papers. So the first one was on momentum-based investing. So, I wrote that one in the summer of, I want to say, 2016 at a Starbucks, not the Starbucks that people unfortunately got taken out of.
We're not going to
talk about that. We're not going to do that.
Next week.
That's next week.
Mine is a big Starbucks holder.
I know, I saw that. But what I was noticing in the market was that momentum at that point in time was really starting to move from markets. You had during that time frame about 4.5 years of just pure momentum-led type of environments. And one thing that I thought about as I was looking at the market was the fact that momentum is most people don't really know it is an investment factor, but it's something that doesn't have any type of financials associated with it. It's really based off of what investor sentiment is, what investors are really looking for, and from there, what do investors think is going to be an investment trend going forward? So that was the first one, and then the second one was about MiFID II. One of the big things that, as I was doing some research last year, toward the beginning of last year, getting ready for a panel, one thing I noticed was the fact that for MiFID II, you didn't really have a lot of investment managers that were prepared for that. Now, U.S. is not as much, but when you're looking at the European market was definitely going to hit hard. And you really started to see the shakeout of that, both for large firms and even for small firms. When you think about the cost of regulatory rules that now people have to abide by, it's a lot higher. The cost of compliance is higher. The standards are higher. And I think it was well-intentioned, but it's one of those things where it's well-intentioned, but I don't know if the governments really thought about the cost impact that it would have on the businesses and how it would change a lot of those models, and it currently has, especially when you're thinking about consuming research and as an investment manager, what do you have to disclose to investors?
Okay. So momentum-based investing, how has that affected you as far as trading the last couple of years? Like, are you getting caught up? Are you getting stuck like in bad positions and getting blown out because of momentum? Whereas like things aren't fitting the actual chart or the setup you're looking for?
Me personally, no, but a lot of people, yes, it is. It's definitely momentum, more so volatility now. I feel like it's really getting people like caught up in like bad positions or whatever, just because the kind of the uncertainty of the market is kind of just going up and down. It's not a trend right now. So based on different fundamentals and things like that, things look good, but things aren't really going with the way the fundamentals are saying. Just like earnings right now, like we had like the bank earnings, and all the bank earnings was good, but the reaction to earnings was bad. You know, just based on what's been going on, it's just unusual. That usually doesn't happen. So like uh, a lot of the bad earnings is bad reactions, and even the good earnings is bad reactions right now. So that's not really a good look. And I've been noticing that like the last few weeks. So if you're an earnings trader or an investor and things like that, it's not really something that is working right now. So that's really tough, like to get a good idea what to do right now. Just everything's just all over the place.
Yeah. I mean, some of the earnings are, I think outside the bank earnings, they are moving kind of with the story. I know American Express reported a really good quarter yesterday, and that one went up.
They
Right.
did. Well, Netflix did really well, and it went back to like highs or whatever before.
Are you shorting that now? I probably would.
It's
it
at
didn't
the
really
top.
blow through the top.
I wouldn't yet, but it's definitely possible double top. I was hearing a lot of people were buying puts towards the top just because they think it's going to pull back, and then. But I don't know. I'm scared of Netflix. Like it's really strong, and I wouldn't bet against it. So that's not something that I would do, me personally.
Yeah, I'm with you. Netflix is heavy on debt. They're debt loaded.
Yeah.
But when you look at their growth, like I don't think a lot of people really realize that Netflix really did not go international until the past 5 years, and it really has just been United States and Canada. If you're looking at it now, it's now in the developed regions, and it's going into developing as in the beginning of this year and late last year. And when you think about that and the fact that what they're doing content-wise, it has the potential to grow exponentially, and you see that within both their domestic streaming numbers. You see it within their international numbers. International makes up close to almost 45%. So, it might pull back, but as a long-term trade, I mean,
it's hard to bet against.
I wouldn't be betting against that.
Me neither.
Yeah, I was asking the truth.
Oh, yeah. But even as a trader, it's hard to bet against Netflix. Even when it's not really doing well, they always bounce back.
So if you haven't heard about Netflix's earnings, they beat on revenue and EPS. They beat on subscriber numbers, which is really trading on right now. They added 7.4 million subscribers this quarter, and versus what Wall Street thought they were going to add 6.3 million. And they have 125 million subscribers as of last quarter. And everything about the business looks good. My problem with Netflix is the cash flow. They're spending $8 billion on content, and they're going to lose free cash flow about $3.5, $4 billion. At some point, that's going to matter. And they're saying like, oh yeah, we're just going to keep doing this for a couple years. Well, if interest rates start going up, they're not going to be able to do a lot of debt, or it's going to be an extremely high interest rate. So I feel like they're going to have. I'm thinking they have four options. They're going to have to either decrease the content, which is possible because they could have so much data that they could target their audience and make instead of just flooding you with content, make certain pieces of it that they know their audience would like. They're going to have to issue shares, which is going to dilute the stock.
Definitely.
They're going to have to come up with some other revenue stream like advertising or I have to wait. Never mind.
No, I think that's interesting. Yeah, I'm definitely with you. You know, they're burning through cash. If you look at their cash flow statement, it has been so. When you look at Netflix, their real growth happened when they were cash flow positive, and and they didn't have a ton of debt. One thing that I noticed with their content, what they did was they actually, and this is smart. A lot of times, and you guys will love this. A lot of times, people will match their debt along with what they view as the quote unquote holding period for an asset. So when you're looking at their content, they actually do the amortization on the content is really high. So they amortize saying basically we're going to get as many users as we can in the first 2 years. But when they pay for the content, they pay using long-term debt. So yeah, so it's real slick of them. So they pay losing long term debt, and to your point, yeah, if you look at they definitely increased a lot of their debt. There's long term debt associated with it, so they're amortizing. So hopefully by the third year, if you're getting any revenue, let's say off of the Dave Chappelle type of series, that it goes to nothing but cash. The issue, and to your point, they're definitely cash flow negative. When you're looking at their debt they got at a better rate than their earlier debt. But you're right, they can't go the rate that they're going.
It's not
Consistently
sustainable.
consuming debt. They can't. They've been issuing a little shares, but they have to be able to issue more. And the bill's going to toll for them sooner or later. It's just a matter of when it does. And they have think about their competition. Like their 30 for 30 is being taken off of there, and HBO is going to house it in their own app, and you're going to pay for that. So as more and more channels start to do that, what ends up happening to their licensing and the number of people that they actually get paying for Netflix?
That's why they're moving more towards original content. So they're preparing for that. But the problem, and I did forget something. They couldn't raise prices.
I was about to say, that's what I was
did
thinking.
a couple of months
They couldn't
ago,
raise prices.
and no one flinched, which is fine. Which is good. They have a good plan of raising prices based on their viewership. So they said they have a fraction of the viewership of YouTube. So they're measuring themselves against that, and as viewership goes up, they're going to raise prices. But again, with the competition, I think they can get up to 15 and no one would start blinking. I think once you get to that 15, 20 range, then I think people will start asking questions and start thinking about getting rid of the channel. It's tough. For me, it's too late. I missed the boat. They would have to have a massive pullback.
Or maybe split again, but I don't see that happening. So it probably will have have a massive pullback, kind of like what was it, 2005 or something? When I'm not sure.
I think it was later, 2012, when they had the two.
Yeah.
They broke out the two stream, like the streaming and the DVD, and everyone flipped out. I don't know why.
Yeah, and it dropped. It dropped all the way like under $100 or whatever, and then it kind of caught itself and then came back. Yeah, we'll have to have a real massive pullback as well.
Yeah, no, I'm with you guys. I love Netflix. Buying it at what their growth rates and expectations are is super high. Even though if you kind of and Mike, I know that you have a lot of balance sheet experience. They don't really have a lot of off balance sheet type of holdings or issues. But just at their price and their trajectory and their growth trajectory, you got to get another pullback in my view. It's where's that now? It could possibly go higher, but
what is it, like 332 today?
Yeah,
so I think it's like right before the massive pullback recently. So it's right up there. So I think a lot of people are probably gonna be selling these highs, but I don't think it's gonna pull back to where it was, because it was like a combination of Netflix, just people not liking what was going on, and just the market in general. It kind of helped. So these good earnings could help, and I think they just did another deal yesterday or whatever. So I mean, they're doing a lot of stuff, but they got competition. I mean, Amazon Prime starting to have their own content, and everybody's getting into that space. So it's going to be tough, because if you got Prime, you don't have to pay for that. So if most people already have Prime anyway. So if they start to get more and more content that's real, close to what Netflix is bringing, and people start getting on board, you might have a problem just in, competition might cause the viewership to get like to shrink a little bit. So that's definitely interesting going forward.
I don't think it's a winner take all sector.
Absolutely not. Everybody can make money.
You're not getting rid of Netflix until they start putting out bad content. I thought if you're gonna buy, if you have, you're gonna keep it. Unless the prices go.
I was about to say, if they go up with the prices,
right,
then people start to see that, well, I can do this for cheaper, or I'm not paying for my Amazon Prime subscription because I already have it, and I get free content with my subscription. People might flock to that, and you might have a problem. So it's interesting to see what they do, like going forward.
It's something to watch, especially with the volatility. That's going to be the first source of funds.
Oh yeah, isn't Apple jumping into this game also?
I believe so.
Yeah. It's still rumor. Like they got a couple shows that they did, and they had a hire. I don't know who it was, but they made people think they're going to put out more video content. Right. Well, since we said that, let me make sure I put this in. All opinions expressed on this podcast are solely the opinions of Al, Myke, guests, and do not reflect the opinions of We Are Stock Traders. This podcast is for informational purposes only. It should not be reliable for investment decisions.
Trade all that. Trade on it.
Yeah. Don't call
Don't
me.
follow my
Don't
trade.
email me.
Don't follow my trade.
All right, moving on. I do want to ask you about your outlook for Q2 and the rest of the year because the volatility I think caught a lot of people off guard. A lot of 2017 was just positive. We didn't have a pullback of more than 3%. So I think when that happened, a lot of people got spooked and we start hearing the doom sayings come out. Just wanted to get your opinion.
Yeah, no. So it's interesting. So I was actually one of the people that did last year. I had the low vol trade on. Cash did when it started going flat, and it went flat. I want to say close to January, and VIX was at that point in time an all-time low. Just ended up buying a couple shares of the VIX. VIX spikes. I ended up selling it. Was it anything for me to write home and call my mom about? Probably not. Because I'll be honest, I did not expect the VIX to jump like that. But we've had, because of the Fed and easy money, state basically killed volatility. So volatility is definitely here to stay. Earlier, I thought it was really good that we bought up financial services. So right now, if you're looking at the valuations and where a lot of things are playing, you're starting to see even though Europe has lagged U.S. year to date, Europe is technically supposed to be that region that's supposed to overtake the U.S. Japan did very well last year, and that was based off of the earnings. But when you're looking at Japan, the one thing is that if you're an active manager, because I deal with active managers on a daily basis, that's the area where they're able to find a lot of alpha because of the fact that the small caps within Japan, it's been a very good quality play, especially if you're looking going forward in 2018, because they're slush with cash. Japan companies have never actually had pretty good balance sheets, and they now do. So I think that's a plus. The financial sector in the U.S. is something that I think that should be doing a lot better, and it's interesting because you had J.P. Morgan come out, their earnings, they did well. You had American Express come out, they did well. So you're having the banks come out that are doing well, but then you're also getting the grumblings talking about, well, the loan volumes are down and there's compression with some of the mortgage issuers. And you got, I think it's Fannie Mae that's jumping in and starting to say, hey, well, we want to do some mortgage insurance too, so we're doing a pilot plan. So you have a lot of things that are murking up the banks, but if you're looking at it and saying where we are within the cycle, also the fact that interest rates are increasing, to me, this is where you want to be. And it's interesting because when I looked at my own personal portfolio and I looked at my single stock holdings, I'm in financial services, and I would tell you that if I was doing a portfolio for somebody else, I would tell them, look, if you're in financial services, your bonus and your salary is tied to equities, fixed income, or anything. You don't really want to have a lot of that in your portfolio. Me, I ended up actually looking at the valuation and saying I do have a lot of that in my portfolio. But I do think that they're going to be hopefully a very good call for 2018. They're also moving. I don't know if people have noticed. If you notice, Home Depot hasn't really done anything significant this year, but the industrials and the financials seem to be moving together. When instead, this is a time that they should be doing very well. One thing I've noticed 2018 so far, first quarter, you have small caps really outperform large caps, and if this trend continues, small caps will outperform large caps in 2018, which will be really good. But I think that might be a signal. Merrill Lynch came out this week talking about, seeing about is this the end? And this might be the end. This might be that blowout period before we hit the pullback. If so, small caps are leading that. You still have growth outpacing value. The one thing I think domestically, which a lot of people might not be paying attention to, is the fact that you've had leadership in the past be so much concentrated into the higher caps because of all the ETFs. Right. What you're now seeing is that if you look at a lot of the equal weighted indexes, those equal weighted indexes are actually are starting to outperform some of the market weighted indexes. So you're starting to see a lot more breadth in the market, which is something that you really want to see. Um, you know, other things, energy should be doing better, but energy's been a dog.
It just got a bump because of the whole Syria
Yeah.
situation. Do you think that's short term or is that gonna last?
Short term.
Yeah.
It's short term. If Syria, it's interesting because you got that going on in the Middle East, but nobody's noticing Saudi Arabia's done very well this year. With the inclusion and a good play on the index, you have something like I think it's the ETF is called KSA. Um, that ETF right there has done I think it's done like 10% probably year to date. That's been a really good play. Trying to think what else. You know, thinking about just the market in 2018. Asia, if I'm in EM, the EM benchmark is about 70% Asian. That's where I think you really want to be. India's lagged, but India should come back. And if you're in fixed income, the short end of the curve. The short end of the curve, you're starting to see the curve start to flatten. The long end of the curve, is not where you want to be right now. You got some people talking about high yields, and because the spreads aren't crazy. If short caps do well, high yields should essentially end up doing well. On the flip side, you have others talking about saying municipals for 2018. I find cyclically they probably will do well, but over the long term, I'm worried about municipals because they're tied to taxation, and if you think of a lot of the pension issues and a lot of issues a lot of states are having, it's tied to taxation. So they might get the bonds, and it might be interesting because what happens if a state goes belly up?
I think that's the next. That's going to be the next thing that fixes it. I think some people worry about I think there's like a new subprime that they're doing. I doubt it's the same thing that happens with. I think it's the pensions in the states what's going to happen because they're still underfunded. We had a pretty good run over 8, 9 years.
Right.
So what happens when we have either normal returns or a down year? I think that's if we have another recession. I think that's what's going to happen.
And people, I think that you don't realize the demographics. I mean, America we're not as quote unquote young as we used to be. Yeah. And what happens in a pension plan? In a pension plan, you depend on your younger group to end up paying for the older individuals that are retired. But what happens when your younger group, you don't bring as many in? They don't come in at a certain salary. That means they're not paying in as much. And you have more and more people retired, more and more people living longer. It's simple math. It's an issue, and then when you're looking at it, their actuarial assumptions are, and this is not speaking bad on any pension per se, but some of them are fairly high. If you're looking at it like, unless you have a very good source of new members, and you just have tremendous wealth and picking, where asset allocation where you need to be along with managers. It's hard to hit 8.5 consistently is hard. I don't think people realize it. To hit 6 is fairly hard, and so that's where with the whole pension crisis in the states, that's where the states are at. I'm originally from Illinois, and I can tell you right now, Illinois is in a pension fund crisis like no other, and you cannot return your way out of that. It's very hard to do that. You have to tax your way out of it, and they've had so many pension holidays that they can't.
Yeah, but with the volatility, are you having a better year trading?
Yeah, I am. I'm not really good at trading when like the market just goes straight up, like just buying the dip. I'm not good at dip buying. I never was. So the volatility, it's even though it's in a range market right now, the ranges are really, really, really far apart. So you can get some good moves in between the range, and usually when people start to panic and sell, that's when you really start to get the really good moves. And the best part about the volatility is you don't have to use that much size because of the range. So I'm not really good like normal markets. You got to use more size. There's not a lot of range and things like that. So this I could play small size, widen out my stops a little bit, and then just play the range. And it's been way better for me personally. it's weird. I guess I'm like a contrarian or whatever. Like what works really well for everybody else doesn't really work for me, and the opposite. So yeah, I love it. I hope it's here to stay, at least for the meantime. Reminds me of 2015, the beginning. It was the same way. It was like bear market conditions, but it didn't last that long. It lasted about a month. And then the market just went straight up after that. And it was like, it was back to the old last 7, 8 years or whatever. So I learned to trade in the bear market conditions. So I guess it's easier for me to identify things that go down more than they go up. So I love it.
Hey, Al, quick question. What do you see with the volumes? Have the volumes been there? Is it fairly light? Is it, or is it streaky?
Well, lately I've been trading futures, so the volume's been phenomenal. So I'm usually like a Nasdaq 100. I don't really deal with the S&P. I like the S&P, but I'm more familiar with the way the Nasdaq moves because I'm so used to trading technology stocks, like that I was more comfortable with just the chart because, like with the futures, the futures charts are the same charts as the ETFs or the stocks. It's just the range is different, like different numbers and things like that. I was so used to looking at them anyway for my normal trades that I would just stick to the cues and be able to play the same setups that I played in stocks with just the different range. So yeah, it's way better because like normally with stocks, like you got different days. Like sometimes it's like really big, like volume because it's news or something's going on, like a big technical breakout or breakdown, and then other days like it's just nothing going on. So like when you play the futures market, it's really liquid every day for the most part, and there's always something going on lately. Whatever Trump says moves the market one way, or
he's been quiet this week. I guess
he has
back
been.
up. Like,
Yeah, he has been. The market has been doing. It's been doing pretty well this week so far. I mean, today it sold off a little bit, but for the most part, yeah, like it's always something going on. So the volatility is great for me.
I feel like the sell off today was more. That was Taiwanese semi came out and said there was going to be less cell phone today than they expected, and cryptocurrency today. So I think that took down tech, which is pretty much hits that the most.
It does because Texas has been leading for a couple of years now. Like so, usually it seems to me like everything goes off of what tech does. Like if tech's not doing well, then that's like to your point. What I'll do is I'll just have the different markets up. Like I'll have the Dow up, I have the S&P, and I have the Nasdaq up, and usually tech's the leader. So if I miss tech, I'll just hit like a sympathy play with one of the other markets because they lag, and they usually just follow suit. So like that's usually the way I trade them.
Yeah, now tech is huge internationally. If you're thinking about, if you look at both the U.S. market and emerging markets, and emerging market indexes, both of those two indexes are heavy tech. And I don't think it's kind of interesting with all the trade rhetoric. I don't think people really realize that, this trade rhetoric, who it hits is it actually hits tech.
And they get hit the hardest.
Yeah, they get hit the hardest because why? If you're looking at their revenues are definitely more overseas. We just talked about that with Netflix.
Yep. Absolutely.
All right. Well, moving on. So put a bow on that. 2018. You're thinking maybe sideways, but then there's no catalyst to 19.
Yeah. I mean, I'll be honest. Like 2018, I don't want to say get it how you live in a sense, but 2018 is definitely going to be, it's definitely going to be some sideways. It's definitely going to you're going to probably still be able to get some runs playing the market caps, playing probably some of the equal weights, going to the areas that should rebound. Like reason why a lot of people are looking at Europe is the fact that Europe is still in that monetary easing phase, while we're coming out of that phase. We're coming off the monetary addiction.
They haven't started tightening.
They're starting tightening, but they're if you kind of think about, like, they went from austerity to monetary easing, and they're beginning to start that, but they're essentially like behind us in the cycle.
Yeah.
So a lot of things that worked in the U.S. Let's say U.S. growth did well. 2015, 2016 growth did fairly well, and growth did well 2017. But 2015, 2016, like those are the times that that's where Europe is right now, and they've been hit down valuation wise. That it's cheaper than the U.S.
Okay. And then, do you think the financials getting hurt too because of the rates that were there, like around the earnings? Like, no one, I got those good numbers. We expect those good numbers, but can you keep that going?
Yeah, like I think.
Well, that's what I was thinking. Everyone was like, "Oh, financials don't have the good earnings." I was looking at the rates.
Yeah, you had people talking about the net interest incomes, and they weren't spectacular, and the loan growth. But if you go down to some of the smaller caps, so this is going to be interesting. Um, I don't think a lot of people have really started looking at the plays you can play in there. A lot of the regional banks are going to benefit from some of the upcoming regulation. Well, what I mean by that is with the upcoming regulation, when we had a lot of banking issues, everybody got slapped with with the same type of capital requirements. Mm-hmm. And for smaller banks, that was pretty strenuous because some of them that weren't even doing that type of lending still had to keep these capital requirements. So now they're at a point where, okay, well, now they actually be able to release some capital. And if you're looking at it like, okay, well, what have people been doing when they get releasing that capital, when they get tax money, and they're able to repatriate funds? It's not like everything's going to wages. You got a lot that people are using for share buybacks, which would essentially help push the market for the past couple of years. So, that might be, that's one area of financials that I'm really looking at in 2018. I think will probably do really well.
And you brought up buyback, which takes me to my next point. After the tax, so at the beginning of this year, I think about a month ago, there was a senator, I did not write down her name, who put a bill in to try to stop corporate buybacks because she wanted the money to go to wages, which I don't understand. You can't tell the companies what to do.
Right.
And so my thing was, when I read this, she should be trying to encourage more people to be into the stock market, take advantage of this, of the buybacks and everything going on. So what I wanted to ask both of you is, what ways do you think, what can we do to increase stock market participation, especially among middle class? Because I know, I read this a while ago, it's like 82% of the market is only about 18% of the population.
I thought it was lower than that.
something really absurd like that.
It's like everybody I talk to is like a lot of my friends, like the moment I mention stock market, it's like foreign language to everybody. It's like, I feel like education, just educating people on the simplicity of it. It's actually not as complicated as people think it is. So I feel like if people understood like just the nuances of like what it means to own a stock, like what is a stock, like what does it represent, and how could you own things that you feel comfortable with it doing well. And like as far as like the thing that I tell people is start out with the things that you use, like Sprint. Like think about everything you use every day. Think about all the stores that you shop in all the time, or these different things like that. Like and just understand this is pretty much what it is. Like when these companies do well, your stock is typically going to do well too. So basically, just introducing it to them and simplifying it enough where they understand exactly what it is, and it kind of takes the fear out of it. I think people are afraid because they don't understand. So just make them confident. Like when you're confident, you're confident. So like if you understand what you're doing, it's easier for you to kind of just go in and just do it. I see the same thing with like home ownership. Like it's like the first time is like always the scary thing, like because no one's ever did it and it's like foreign to most people. So just education, just keep educating them on.
I find that crazy because we live in an era where the information is at your fingertips. So the fact that some people would not look into it, if you tell them they will look into it, it's kind of
Well, people are
surprising.
lazy, first of all.
Yeah, and that's
People are lazy. They want people to do everything for them. I mean, just think about it. You know, like I think that's like the first thing. It's like they want somebody to tell them something. Like I've seen more people buy a stock because somebody told them to than them just doing something on their own and just try to.
I get this all the time.
It is like people just want something handed to them on a platter.
It's interesting. So when you think about first of all, it's something that really needs to be in the curriculum for schools. I mean,
That's definitely.
But most people don't really realize that we want to be like our parents, and our parents came up in a different age than what we're in now, and we're in the age of it is now the DC age. It is now on you to make your own investment decisions, and one of the things is that so you have to make these investment decisions, but you most people don't want to read. You gotta take the at least to take the time out to read. But I like really right now. I gotta shout out John and We Are Stock Traders, because this is one of the very few. It's not a lot of platforms that you can actually have a lot of investors coming in, and you have access to them. I think that's the one thing. It's being able to have access to the industry. And being in this industry, we all know like it's a very closed industry. If you did not know us, you would and you did not talk to us, we wouldn't be we're not always sharing information. Yeah. I mean, I am too. Through the blog. Shout out to everybody's blog. I know we all blogging out here. But when you're looking at that, like and let's be honest, it's not something that it's not fashion. I think it's people can
sexy.
It's not sexy. People can touch real estate, and I think real estate is easier for people to understand.
The concepts are similar to me.
Yeah, the concepts are very similar, and I don't think people really realize how much of a risk they're actually taking. I'm like, they're taking a lot of illiquidity risk within there. Then on top, when you're looking at it, like the barriers to entry are high. I think NPR just came out with an article, and they were talking about house flipping. And on the article about house flipping, just to get into that now, before the market crash, you can get a second mortgage without blinking. Now you literally have to have close to 50% of the money for that second home to be able to flip. So if you're trying to flip a house that is at least $200,000, you probably need to have 100 just to get in, then another $50,000 to maybe do some improvements. Mm-hmm. And we look at the margins. I think the margins are they were quoting about 10 to 15% according to
have good credit.
Yeah, you gotta have good credit.
Familiar from HGT.
Yeah, 10 to 15%. I mean, 10 to 15%, and and I think it's you can get some really good profits, but most people don't realize like stock investing is also passively participating in a market, in an environment that you can make money in, and you have to be able to do it. You have to educate yourself, but at the same point in time, you don't actually have to go to that house on a daily basis. You don't actually have to call that contractor on a daily basis. So I think that's the one thing that people do best.
It's more self-sufficiency.
It is.
And I feel like the thing is that I noticed, like when I first got into the game, you'll find, and it's weird because like, me being a trader, it's very uncommon to find other traders that I know or just to meet them randomly. But what I've noticed is just about everybody I've reached out to has given me positive feedback, has wanted to build rapport with me, different things like that. I found that people were way more willing to share their information in the market more than anything else I've ever done. It's like it's so much of a gimme, get out of here. Like I'm not sharing. Like in the market that I've noticed, like the point that you gave, like with John and what we're doing, John does so much free stuff for people who doesn't know anything about the market, just introduction stuff. Like there's not people out here doing that kind of stuff, and so like you said, it's out there,
especially for free.
It's out there for people to get acclimated with different things for free and even for very cheap. like it's like way cheaper than you'll try to get some investment home flipping course. It'll be like $5,000 or something. They don't even tell you anything, and they kind of make you fend for yourself. You kind of like rip off or whatever. So
I just wanted to point out the reading point. That blows my mind because I have a website, readingreports.com. Check it out. Anyway, and this even happened last week. Someone wanted to get invested. I said, I think MindBody you might want to check out. I think that's a good one to buy. I think where it was at $38, $39, whatever. That might be a good price to check it out. But go to the website. Here's the link to the website. Here's the report. It's like 6 pages. Like, no, I'm just gonna buy it. Like, no. Like, it's 6 pages with charts. It's really 4. Like,
yeah.
And if someone has told me before, yeah, when I go to the bathroom, that's when I read the report. Fine, whatever. If you're scrolling on Instagram or Facebook for 30 minutes a day, you take the time to read the 4 pages to understand the investment and just follow it. I tell people that start in an index fund and then you can see if you want to move out to individual stocks. But what also is funny is I think we just live in an instant gratification society, whereas everyone wants everything now. No one wants to wait. No one wants to work through anything. And you see that I have a couple friends who will not invest in the stock market, which is way better odds, but will go to a casino once every 3 months and spend hundreds of dollars. It's like, that doesn't make any sense remotely. But
I guess that kind of makes
you can make
think,
more.
Like where they're headed. I don't think they care. I think it's about the rush. They're probably not interested with like doing something longevity wise. I just think that the thrill seeking.
I mean, I get the same. I don't know.
I do too.
I long term invest.
I get a huge rush from making a trade, like a good one, obviously.
But then I got your point. I like sharing, and I would talk to some people.
Me too.
Like, if you have any questions, email me, call me. I don't care because even you're helping me because I bother my fiance with all this stuff. She's tired of it because I like to ask people questions before I make a decision, especially someone like her that's not into business that don't really know. Because it puts more pressure on me to be able to explain it to her. Right. And I have to know it better. I think that's the best way to learn things, explaining it to others. That's why I like writing a report. That's why I like communicating about this stuff because it keeps me on my feet.
Yeah, no, you guys are definitely right. And the most interesting thing is that because I also came from a financial planner type of world, most people aren't planning like 30, 40, 50 years out. They're not planning, they're not planning that far. So, but you think about it, if you're just trying to survive day to day, you're not thinking about the stock market. I think that's where we're at right now. If the average person earns $59,000 a year, if that's the average person, and you pay close to $1,000 a month for rent, and then you pay close to $450, $500 for a car, along with you got to factor in insurance. When you start, then you might have close to $300 in loans. Like, how can I invest in the market? And I think that's one of the things that we're at. Like, between that, the cost of healthcare, cost of education. Like, people are like, well, I'll get to it, or this is something I'm interested in. But I'll be honest. I've personally dealt with cases of people that were 50 plus years old, and trying to say, okay, well, I got to retire. And you look at the person, you're like, well, how are you going to do that? Like, it's a scary conversation to have with somebody.
And that situation is different. When you live in paycheck to paycheck, you don't have it. I get that, but there are people who have money in savings accounts, and you're just like, in my age, with savings account with $1,000 in savings account, just like, what?
Do you think it might be the fear? Like, just
I would think that, but it's the same people going to the casino. I was just like, well, it's the fear. If the fear's there,
well, I guess
we have to buy education to be like, the fear shouldn't be here because on average you make 8% a year on average, long term average. And if you were in the last year, that was the year behind.
5%. But I think that's to the point. That's where most people they gotta be in to be able to play. They have to take time to read, and they have to ask a lot. People don't want to ask questions. Yeah. I mean, if you think about it, your stuff is free. Your stuff is free. My stuff is free. So you got people up here. John does a lot of stuff for free. We are stock traders. You got a lot of people giving you.
We got all these different
free games for less.
Come on down.
Free game for $9.99. This is Jay-Z charged more to get people to think about buying a flattened Dumbo,
or some
Look
art.
where we at.
Yeah, come down next Thursday. We're having an event all about the dividend stock and trade, stock investment. So come on down, learn something. I'm telling you, it will change your life. Because what I see happen too, I got a couple people investing in the stock market. You start changing your spending habits because you get that little return. You realize, oh, I put like a couple $100 in. Oh, imagine that was a couple thousand. What that return would be, and then you start looking for ways to make more money to save to put into the market. But I had a friend, and he was telling me him and his wife were spending over $1,000 just eating out every month. And all of a sudden, he started investing. Now it popped up on Instagram, Snapchat, meal prep videos, making food for a week. And so I know it changed. I don't spend a lot of that too. So, but I think for other people, it will end up changing your spending habits because it introduces opportunity costs. So instead of the money just sitting in the bank account where I can spend it on Jordans, you start thinking, well, I have this stock I like. I can put it in there and get 10, 20% return maybe for a year and a half or whatever instead of buying Jordans. And I think that's the big thing. It's savings, not sexy. You can't show off your savings account. But you can go out and buy that car that looks good. You can go out and buy that new watch or new outfit that looks good. So I think really just educating people. And I think we're fighting an uphill battle with just people being patient. It's just patience and taking your time and waiting for it because I think that's your advantage as an individual investor.
But you notice something I've recently, especially like some of the things that John's been doing, I've noticed a lot of younger investors, like people like I'm talking about 19, 20, people in college.
That kind of makes me wonder because after the year we had last year, I feel like people might be coming out.
Well, it's so interesting you said it. So I remember seeing a couple people and they were like, hey, we got this Robinhood app. This investing is easy. All of a sudden, the market drops.
Yeah.
See what I'm
I
talking
was about to say crypto
It
too.
gets-
I think
it gets
crypto had a lot to do with it too.
real
Because
quiet.
crypto kept going up, like the Bitcoin thing. I think that's another thing that kind of had people wanting to get in because like you would literally put your money in and it just double or whatever. And now that it kind of came back to earth, like you said, like you don't see those same people. They could have probably put their money in and got hurt pretty bad, and now they're like afraid to try to go back in.
So all those people, if you invested in a stock that went up really high and you got in at the end, I was the person to get mad at because he probably shorted that stock and knocked it back in.
I don't have that much money.
So yeah. Speaking of retail investors, what advantages do you think they have? We can talk about disadvantages too, but I mean that's what scares a lot of people. But let's start with the bad news.
Let's start with the good news.
Yeah.
Let's go good to not so good to hey, let's end on a nice smile, open a smile with that one. I think with the retail market, you have three things. You can be retail investors can be a lot more creative than institutional. They don't have a ton of guidelines. Also with that, they can get in things. I mean, we were talking before the podcast. You can get in things a lot faster, and you can do a lot more esoteric things. You can do a lot of more esoteric strategies. You can take a lot more risk, and it can be tailored for your individual specific needs. I think that is, as a retail investor, that's one of the joys of it. And even myself, when I have my own retail accounts, that I have, I'm like, I think that's the perfect joy is I don't have an investment policy statement. I don't have guidelines I have to follow. I don't have a lot of these things. Now, you also heard me mention like, look, I'm like, I also take a lot of concentration risk, single stock concentration risk too. So, it allows me to be able to take as much risk or take as less risk as I want to. And I think as a retail, like that's the biggest thing you can do.
I second that. Like basically just the fact that you don't have to be in a stock. You can wait for the perfect time, because everybody knows that, we can't move the market. Like, we don't have the kind of money to move the market. But once you identify what people want that are moving the market, and you could just wait for it to happen, and you don't have to be in every day, any stock. You could just wait for the right time, and then you could be in with as much size or as little size you want, and you could have different choices. Like you have options. Like it's I think it's probably the easiest. I think it's more benefits for retail investors than things against them. I really do. Like I think this is the best time for them. Um, and that's the thing that people don't really know. Like the fact that you have discretion is your biggest edge. Is your biggest edge. Like you just wait for a trend and hit the trend, and you can always add to a position. You don't gotta go. Me and Mikhail talk about it all the time. Like somebody just loads up, and just you can just wait until it really starts to go. Because usually when things are trending, they usually trend for a while. If you're in the right stock, so you can just start in small and just keep adding to your winner. So you just wait, be patient. Patience is an investor and a trader's friend. Most people don't have it, but like patience pays the bills.
Yeah, I would just piggyback off of you guys about discretion. Yeah, I'm out this year about a good. I don't know. I didn't check today. A good decent amount because my biggest holding is a company called Check, which is a small cap. And most institutions that you can't.
That's another.
And when I first purchased it, it was under $10 and it was under $1 billion, which I don't think institutions like. They probably wouldn't touch it because they have to put so much money in there to get it to move.
It depends on because usually institutions you're divvying it up by investment managers and their strategy. So as long as it was in a benchmark and a strategy, they could probably touch it. But then what happens is that you end up having unless you have somebody that has a true buy and hold mentality, a lot of times as soon as it hits that market to where it gets kicked out and it goes up to S&P 5 or it goes up into the Russell 2500. If you're a small cap, you end up having to say, okay, I got to drop this company.
But some of them have guidelines that you can't go under $1 billion down here. Yeah. But I was watching, and I think at the retail, you kind of see things. You can kind of see things maybe before they break out because at least for Check, I was still checking like CNBC and Yahoo Finance, and they were still saying it was a textbook rental company. Whereas the company's already saying, like, oh, we're doing a digital model, we're doing more digital services. That's for students. That's why we're making more money. The money's going to expand. And you can go on Twitter and type in Check. You see all the students how they love it. You talk to college students. Like that was happening while at least the news organizations were still behind all. So I was able to get in, and then even the last call they had, see a lot more of you guys follow us now. And I was like, oh, okay, I beat them in by the time institutions came in, it spiked up and they pushed it up. So I think that's your advantage as far as, and I don't know, don't lean on that if you have to do just small caps. Like that's probably really more riskier. And
that makes a great point, though. That makes a great point. But because, like you said, you got to think who's in your stocks. Like when you're dealing with small caps, you're dealing with retail for the most part. So you got to think about it. If you're dealing with more people like yourselves, it's gonna, especially if you have some type of idea of what you're doing, it's gonna give you some type of advantage over most people who don't know what they're doing. So if you're dealing with larger caps and bigger funds, you're gonna have to deal with people that they're trained to take people like you's money. So you want to deal with the people who don't know what they're doing, and things are way more predictable. And like the small cap, that's your advantage as well. Like predictability. Stay away from illiquid stocks because they're very unpredictable. Because you got the HFTs and things like that. So to piggyback what you said, I think small cap it might be riskier, but I think it's way more predictable, and you get better odds, especially if you want growth.
Well, so here, because I'm on the institutional side, so if I think about it, like all the stocks you guys mentioned, like Chegg, like I actually had guys that own that, like they own Chegg, They actually own
This is
Life
in their.
Block.
This is in their.
This was in their
individual one?
this was in their portfolio. Like Chegg, they had Life Block. They actually
like
had
that.
Amberella. They had Stamps.com. They had Nectar. So you know when you're you know, and there was a couple other like it was actually one I was on the call today that had one of the small cap ADRs. But the thing is with small caps for institutions, you know, you have so many small cap managers, and
Like at the firms.
and in the firms,
Right.
and most people don't realize like so if you're looking at your vanguards, look at their average market cap. Like they're actually not so much your average market cap, but look at the total market cap for the fund. Look at how much total AUM for the fund. Total AUM actually dictates what they can invest in.
Yeah.
So, you know, like one of my part of my job is to figure out at what point in time do I want to get out of a manager because they can no longer invest in a certain space. And so you're looking at saying, okay, well, if I know you're a fundamental manager, once you hit about $2 billion, this might be a time. If I'm in the small caps, this might be a time for me to start looking at exiting because you can no longer get some of that micro cap exposure that you were talking about. You know, but also to the point about Chegg people couldn't get into because usually that $10 range, you'll start seeing a lot of investment managers that on the institutional side, they'll say, okay, well, I don't do anything lower than $10. So you know, so you have those specialty things, and for a lot of the managers, like the best ones aren't the ones that you consistently hear about. The best ones, like I one of my best finds ever were some guys out of Southern California. But when I tell you, if you saw their returns, out of the park. Small cap growth, out of the park. They're still, I mean, I've known them for now close to 4 years. My firm is no longer invested with them. And I cry every time I see their returns. Their returns are still that good. They are just that. They're just
concentrated.
55, 60 holdings, small cap growth. You know, but these are some guys that I asked one time. And so here's the biggest thing. Like some people won't realize. Like I remember I asked them one time, why don't they own Amberella? They gave me the reason why they don't own Amberella. They told me who was buying Amberella, why were they getting in, why were they getting out, and if they wanted to do a play on Amberella, what stock would they own that fits their bill but isn't Amberella? That's the difference. Honestly, really, that's sometimes the difference. That is the difference between retail and institutional.
And then also, I think another advantage is you don't. And I've seen this at the end of the last 2 years. I feel like there's been a benchmark rotation, whereas financials took off, and you're a portfolio manager. You probably speak to this. Your bonus and extra incentive might be tied to beating the benchmark.
Correct.
So then, as the financials go up, as the tech goes down, you got to buy those financials at least 7 tech so you can stay above that benchmark.
And it depends, like, so, you know, it depends on the type of management style. So if I'm looking at a quantitative manager that has some type of momentum factor within their process, you know, they'll definitely rotate over to financials. Or if they were saying, okay, hey, you know, some type of trending still momentum, they're going to rotate over to financials. You'll have others, like I have some guys that financials did well, but they're 60% in tech. So last year, they were down close to 900 basis points. This year to date, they are up 700 Year to date, they're up 875 basis points. So, you know, for institutions, you know, it depends on their style, buy and hold, more of a trading. Their time frame, is it 1.5 years? Is it more 3 to 5 years? You'll actually find it's probably closer to more 1.5 years. And what factors do they have to stick to? Because I think, to your point, the creativity and retail having more discretion, you're not bonded by, okay, I have to stay in this certain style box. Right. Because in institutional, if you don't stay within your style box, or somebody starts to reach your style drift, right, and you style drift, either you outperform or you underperform, you're really going to hit somebody's watch list. And once you hit the watch list, like, that's kind of like hitting that naughty list first. So saying that you don't want to be on that one.
I got a question. So with the you was talking about some of the funds talking about they don't go under a certain rate. Is that illiquidity issues or just risk issues with like the smaller cap stocks, like under $10 or things like that, or both? Or like what determines, how low they'll go as far as price, or if they'll deal with small caps or anything like that? Like how does that work?
Definitely, it depends on what their AUM cap is for that fund. Also depends on their level of concentration and its risk parameters too. Because certain funds they can afford to be illiquid. So I mean, I know there's a couple micro cap funds that they go down to 250 million, but they're not. They're also they also say like, hey, at 500 million, Floyd, I'm closed. So once we hit 500 million total assets under management, you can't get in.
Yeah.
That's it. So it's part of its risk, but also part of its like the structure because they want to make sure at a total funded at a total AUM portfolio they can still run it the same way they ran it when they only had a million.
Got you. I got you.
That's usually the goal.
I don't know. That even like with some retail traders that I know, like a lot of the people that I know that started out small caps, like the bigger and bigger and bigger they get, it's harder for their strategy to be plausible because of the liquidity things. Like it's people want to really size up. You got the slippage. You can't get out because you don't got people on the other side of your trades that can like take whatever your order is. So it definitely becomes. I know if for a retail trader who trades really big, I know a fund's definitely gonna have they're gonna mess the market up big time. If, trying to get in and out of a position or whatever. So I definitely can see that.
Oh yeah, no, that liquidity right there is the reason why. To your point, like you'll have some that can jump down and be able to get checked, but a lot of them can't. It's just the way it's set up. But the one thing I will say is the institutional side. You look at the tools.
Yeah, that's good too.
The tools and the analysis are at a whole other level. Like it really tools analysis.
I always wanted to know that.
Yeah, the tools, the analysis. When you're looking at the availability of research, the type of research.
Right.
Like when I look at and this is on a daily basis. When I look at something like so I use TD Ameritrade. So I look at TD Ameritrade and I say, okay, let me see what the research has for TD Ameritrade. I'm like, this is garbage. When I look at FactSet and Bloomberg, because I mean, and it's interesting because FactSet and Bloomberg, I got stuff streaming to my phone, I got stuff streaming to my laptop, I got it, I got the terminals and everything else. I get stuff instantaneously, and to be honest with you, I'm like, I can literally put together a paper portfolio, going ahead and say, okay, here's how I want it to look, trim and do all the risk parameters, look at it different 20 to 30 different ways, and create a portfolio. And if I'm like, I'm thinking about it retail-wise, for retail investors, it's like, okay, this is where like the tools and all the gadgets come into play. But I do think that there are a lot of tools coming to market soon, and a lot of fintech initiatives that will hopefully help close that gap because it's a gap that needs to be closed. I do think that, in my view, it might be 10, 20, 30 grand for a FactSet. But per se, like as an individual investor, I should at least be able to have, even if I can't have FactSet, I should have something that is decent. And can get me the type of returns I want. And I think you're starting to see that now, and hopefully that trend continues.
Do you feel like more recent, I'll say within the last 5 to 7 years, that gap is getting a little bit smaller between the different nuances of what institutions have at their disposal to retail, if they're willing to pay for different things, the access. I'm just saying the access, not the capital.
Oh yeah, I think it's with ironically with MiFID too, the way that's impacting a lot of the investment banks, and they're going to one banking model, not just for the U.S. and then one for Europe. They're doing it global. That right there is helping a lot of people out. The fact that now it's like, okay, well, between that, the trading volumes, the cost of trading, so you don't have 50 million analysts covering. If you think about it, think of the analyst coverage. The analyst coverage is actually going down. And so, even in your mid-cap stocks, you're finding less and less analyst coverage. And I think that bodes well for retail investors because one of the biggest things was, retail investors, well, institutional, you had so much information, you had so much sell side research. Now that the sell side research has definitely come down, and a lot of the information is public, and you start having more, more places of, more hubs of information, like the one we're at right now. You can, as a retail investor, you can do, in my view, you can do a lot better than you could like 5. Even if I think about when I graduated from college, like, you could do a lot better now than what you could do back then. Even down to just think about when you're running spreadsheets. Like, I kind of thought about you as we were going to talk today about Netflix, because when you're inputting data for Chegg or NVIDIA or any other company, you can actually go quickly download all the financials in an Excel format. Just think about it. Years ago, you couldn't even do that. Even if you had Excel, they didn't give you that capability. And if I think about it institutionally, I know when I want some information, I go to my fact set. In less than 5 minutes, I can pull down all the information, plus have all their 10Ks, all their 10Qs right there. And I can say, okay, well, I can run through this information. Okay, here's what I need to know, and pick all this stuff up. And just think, if you're building an investment model, how much time that saves you.
I don't want to talk about that.
No, but
I'm doing that.
I know, no, but it saves you a ton of time. So I mean, and that's the thing, like, and then on, like, I mean, then when you got on the fintech, like, I know there's a lot of tools coming out that will actually help investors, like, do the analysis. And so there are more fintech tools that help them do the analysis, so they don't have to do the number crunching, and they just have to say, okay, well, here's kind of what I want for my portfolio, and build it from there.
Yeah, I would say a story I heard. It was the retail analyst from JP Morgan, and he talked about how. So retail analyst, that means he's looking at retail stores, department stores, everything like Ross and TJ Maxx, everything like that. They actually have drones that fly over parking lots, that take pictures of how many cars are in the parking lot, and then they also look at how many people going in the stores, and when they come out, how many bags they have. That instantly told me, short term, I can't compete with these guys. I'm not going to try. I'm not going to remotely even get into that game. I just try to find good businesses that I can clearly see how they're going to grow, and hopefully maybe beat people to it. Because I know a lot of people, I think I've read, and it seemed like that, at least 2017, all the rotations. Institutions aren't holding that long.
Yeah.
No. So if I can find something that maybe like a 2-year growth story, or like it really won't kick in until maybe next year or maybe 12 months, get into that and maybe hold it and wait till that time comes and catch the wave.
Yeah, I was about to say. I definitely about to say.
Yeah, no, I mean the holding period for stocks is going down. I mean it used to be 5 years, and it went to 3 years. Now it's that, like, the average holding period is like a year and a half for a stock. And you think about
I heard even less than that.
I wouldn't be surprised.
And I was about to say, to your point earlier about, and another advantage for retail is knowing what's going on, and you kind of catch different things that Wall Street might look over, and you're into something before the crowd, and then, like you said, you can just sit and wait.
It's too far out; they're not going to buy it.
Yeah, exactly. And then when it hits, if you really have conviction, there's this one guy I saw him on YouTube. He turned like 2,000 and like 2 million, and this was invested. This is over maybe like a 3-year period. He was investing in small caps, but what he was doing was he was just picking these companies that were kind of ahead of his time, and it was kind of before he got into them, before like the big boys kind of figured it out, and then when it hit, he just caught like big. I mean, lucky for him. I mean, it was risky. He kind of went all in every time, but he kind of caught the wave and he like doubled and tripled or whatever. But that was like his strategy, like try to find things that were ahead of their time, and Wall Street didn't catch on yet. And then once they did, when everybody was getting in, he was getting out.
Sometimes you can just find things out of favor. I know like Home Depot's not out of favor right now.
Oh, it'll never be out of favor.
But it ran up to like, not completely out of favor, but it ran up to like 210.
Yeah.
after the tax.
What is it, like
cut.
170 or something?
You know, it came back to 170. That's when if you're a retail, you
Yeah.
jumping in.
But yeah, I was about to say something like that'll be around. Like it's not. That's. I mean, they got it's good dividends and it's still. I still think it has pretty good growth. To go forward.
So that story is a lot of it's time period dependence. Like I think that like most people don't really realize like strategies come in and out of favor, and factors come in and out of favor, and what might be valued during a certain point in time that he might have been queuing in on, goes really well. And and that's how it goes. But if you take that same type of investment strategy, you throw it in a different period, it might
not work.
That's why I get worried about people buying these trading classes that see like advertising. I don't know if that's going to work now because it's time period. Whatever, if buyers did in 2017,
it doesn't work.
You just try that beginning in 2018.
You get killed. You'll get killed.
But I think like one thing is that like most people don't realize like institutional investors, like we're talking domestic stocks. Like institutional investors can actually say, okay, I want to invest in India. Yeah. Like they can like, okay, I want to go to India. I can buy these P notes. I can get in there. I want to go to China. I want to buy these A shares. For us, we can't do that. And so I think that's and that's the one thing that I think
unless you buy, I guess, an index.
Right. Unless you buy an index or you buy a mutual fund or an investment manager. But other than that, like they can actually say, okay, I want to open an account in India and trade there. Okay. And so for us, we can't do that. And I think that right there has a significant difference because you can, we can load up on all the U.S. stocks we want to, but you're looking at saying, well, I can, you can load up on U.S. stocks that the GDP can barely hit 3. Or I can go over to India where GDP is probably, it's actually higher than China. China's 6.4. I think India's close to 7. So, just baseline, I should be able to get close to 7% return. So, there are some advantages. So, I mean, and that's one thing I always remember. I think, most people have to forget, like, remember at the end of the day, like, institutional, there's a reason why they say institutional is a smart money. Like, it's a reason behind that.
Yeah. So you have to invest. Don't like the outlook and always just another Thanksgiving. Please, you still gotta invest because there's inflation, prices, everything go up. So you gotta make your money work for you. What are you guys working on to do a better investing? Because that's something. That's what I like about this game. You constantly learn. You constantly growing. It's never stagnant.
For me, more reading. Kind of what we were saying about like the 10Qs and 10Ks, like reading financial reports, actually digging deep into, the balance sheets and what the companies are doing. I think that's everything for me was all technical. So getting more into understanding exactly what companies do and, what they're looking to do in the future and, who their competition is, just all those different things. Like that's where I feel like I can get better at and just kind of mesh the technicals and the fundamentals together. I think, you can do a lot of damage with that instead of like one or the other, like me, because I'm kind of one side of it.
I think it's the same. I mean, I've probably spent, over the past 2.5 years doing a lot of reading, building a lot of different models, not just for individual stocks, but also in different market spaces like your peer-to-peer lending, even crypto. So for me, it's been really a lot about being able to understand broad markets, being able to understand what's going on, and being able to put things into play so that I understand how everything's interconnected. That's the one thing I think a lot of us forget. You kind of think about it. Who was George Soros recently? That he kind of bashed crypto. You had Jamie Dimon bashing crypto, but then all of a sudden you hear behind the scenes that these guys are J.P. Morgan has been looking at crypto and investing.
Oh, you gotta knock it down.
And Soros, you hear about within his foundation is set up now to be able to start trading crypto. So you start looking at that and start realizing that there's ways to make money investment wise. So there's arbitrages all around. You just have to find them and you have to be able to understand that. So that's what I've been concentrating
on. I've been concentrating on 2 things. One, financial modeling, because eventually I need to turn this into a job. it also helps evaluation too. But, because sometimes I'll get in between that. This is a good business, but it really ran up, and I think just modeling will help me like be the decision maker. That's one, and I actually started doing that, but I did the worst one to start. It's Take Two Interactive. It's a video game company, and numbers all over the place because they got game delays come in, it's different revenue. So Floyd expect anything in box. It's and then the other one I've been working on is psychology because there's been plenty of times where I'm just fascinated with psychology regardless because my fiance went to school for that and kind of works in that. And I kind of got into it when I was coaching basketball, but I couldn't understand why the kids were doing what I was just telling them to do. But now, just as far as investing, I got into it because I could see like sometimes I make a plan, and then it comes time to act, and I just won't pull the trigger, or sometimes I'll get scared out of something. I'll make a quick decision, and that happened a lot last year. And I was just this year just trying to figure that out. So really been reading a lot of books, which has been fantastic because it helps me. I've been learning a lot, like for example, like just how the brain works as far as like when you have gains in the market, you have losses. Like losses affect you twice as much as gains, and like when you just how people try to think of everything in absolutes instead of probabilities. I think that's the biggest thing I've learned this year. So like if I buy this stock and it goes lower, doesn't mean I was wrong. Just maybe the probability of it going lower was 20%, and that 20% just happened to happen, rather than the 80%.
Timing possibly too.
Yeah. So just not worried about focusing on being completely right all the time. Just saying like that's why I got a false average. Buy it. You kind of want it to come down, so you can buy it again. But I've been more focused on just setting plans like every weekend and really just executing when it comes time, and just kind of keeping track of that process. And just maybe fine tuning that process so that I can, as much as I can, take the emotion.
Another thing for me is just trusting the process. Like, I see a lot of people jump ship. Things aren't working, and they try to go from strategy to strategy to strategy to strategy, and you really don't, set in stone one thing. You're just like all over the place. Like sometimes you just gotta, you have a strategy that you feel comfortable that works, and especially in my field, like with trading. To your point, psychology. Um, Most strategies work. Like you can pick up a book at any bookstore, the basics to trading. Everybody says the same thing. It's not really their strategy; it's the individual applying it correctly. So if you do what the strategy says do to a T, because there's a difference between knowing what to do and actually doing it. And I think that's it. Like just sticking to what you're doing and just kind of working on that. Like don't jump ship when things don't seem right. Just kind of just make a little change here and there. Take a little bit out, add a little bit in, and just kind of like massage it a little bit. And don't just keep going from one place because you'll never stick with anything because you'll never understand anything totally like any strategy because you just wasn't in there long enough to figure out all right this works.
Yeah, I would just to add to that, just take notes. So you got to try different strategies at the beginning to figure out.
Yeah, absolutely.
But then take notes to see like
what works, what doesn't. Yeah, because that's what I did. I just pretty much I went over every trade I ever made, and I basically and like you said, take notes and track everything you do. Like, all right, well this worked. Well, why did I buy it? What did I see? What was the setup? And then you put it down. When did I sell? Why did I sell? What did I see? And then eventually you'll start to get a pattern of yourself and see the things that you do well, the things you don't. And it was funny, like when somebody told me that, like I'm a pattern trader, and stocks have patterns, but like people have even bigger patterns. So like once you start to put that stuff on paper, and you start to see like what you're good at and what you're not, just by taking out what you don't do well makes you a winner. And it could be that simple. You be like, all right, I do this good, I do this good, I do this good, but I'm just the worst at this. You stop doing that, the difference between you being a winner and a loser you could have thought that it was I don't know what I'm doing. No, you just gotta stop doing things that you're not good at doing. It's okay. Like everybody is not great at everything. Like the best information that I got and advice is, stick to what you're good at. It's not about being a jack of all trades and investing or trading. It's just about being great at one or two things, and that's where your money's gonna be made. So
Yeah, you're definitely right. The one thing that as you were talking that I thought about was the fact that this is so this is where the access information comes to. Like, so you have Capital Research that actually does a lot of the buy, sell, and hold bias there, and then you have other institutions that look at that and say, okay, where did you buy at? Where did you sell at? Where where you sizing right? Mm-hmm. So you start seeing all that type of information, and that's the and from my view, from dealing especially dealing with guys or professionals that have been doing it for like 20 plus years, like those are the things that they're starting to do now to implement. How well do they really understand their portfolio, and what are they doing? And when they don't do well, why don't they do well, and how can they avoid? I mean, really more it's avoid. You're gonna make mistakes, but it's avoiding the significant downturns. If you can avoid the significant downturns, I mean that's just the law of numbers. As long as I can avoid being negative 10%, if I can be -5, then I'm gonna win all the time, at least -7.
That's like the temper. You got get into the game, just stay in. If you can stay in the game for kind of I would say 6 months to a year, you get a better understanding than you had before. Not a complete understanding, but you would feel a lot more comfortable. Okay, I'm kind of seeing what's going on.
And another thing is, I think exposure to different market conditions is good as well. Kind of with your point of like, what might work this market doesn't work in this market. So like if you see different market conditions, that kind of adds different tools to your toolbox. So you're like, all right, well, this is not going to work now, but in this market condition, I could bring this out and this will work. So like knowing what works in what different markets, it's very, very important because markets change all the time. So you got to have different strategies for different periods.
Right, we're way over time. Let's wrap it up with this final question. I mean, the Sixers are on Floyd's money in the draft. So last question: what stock are you looking forward to the most this earnings season?
That's easy. Facebook. For me, I mean, because not just because of what just happened recently. I mean that, but even last quarter they didn't beat expectations, and so I want to see if this has the same thing, some type of effect with if they don't beat expectations again. That'll be really, or it will be even more if they do beat expectations with this. That kind of lets me know that they kind of swept this under the rug. So I'm really looking to see how they do.
Ooh, I was looking for American Express. American Express reported. E-Trade sold the B's and also Schlumberger.
Okay. American Express, that was a great quote. I like that. I'm looking forward to Take Two Interactive and all the video game stocks because of the whole format. And with not the game that worries me, it's the free to play model. I think that's why it's so good because you can easily download it free and just start playing. So worried about that kind of business coming into this video game industry that sells games at $60. Do you want to tell people where they can find you at?
Yeah. So if you're on Instagram, financial.floyd. If you are on Facebook, you use my new Facebook page. Actually, I revamped it. Financial.floyd also. And on Twitter, I want to say it's by F Simpson. I gotta change that.
I gotta follow you on Instagram. I didn't even know you had Instagram.
Yeah, man. Hey, Robert Smith follows me, dog. I'm coming up, man.
All right, you can find me at readreports.com. That's probably the best place to find me. You can email me there, or you can find me on Instagram, mykemoney87, MYKE is Myke underscore, and then Twitter is mykemoney87.
You can find me Facebook, Albert Jones, Twitter, Pain to Realize Gain, and or you can email me, albertjones58@gmail.com. So probably the three best ways to find me.
And also, Myke, I'll tell you, you can follow Myke's Instagram page. He's gonna tag you in all the good books. So if you need books to read,
He's got
follow his
okay.
page.
I got
You know what I'm saying? Go follow
Yeah.
his page.
All right, well, that's it for this week. Tune in next week when we have Ron in here, a large Starbucks shareholder, while we grill him about things. All right, take care.
Peace.
Yeah, peace.
All right. Good
Take
stuff.
that, brother.